Imagine you have $10,000. By Tuesday, it is worth $6,000. That is effectively what happens in slow motion when you misallocate capital in your late 30s. Between the ages of 35 and 45, you are going to make three very specific decisions about your marginal cash flow. That is, the extra money left over after the bills are paid. Let us call it $500 a month. Most people make the mathematically incorrect choice in all three scenarios because human brains are wired for evolutionary survival, not compound interest. We seek immediate emotional comfort over long-term mathematical reality. These three decisions revolve around your mortgage, your kids, and your healthcare. If you choose wrong, it will cost you over $450,000 in lost net worth by the time you retire. Today, we are stripping out the emotion, the societal guilt, and the historically flawed conventional wisdom. We are going to look strictly at the brutal math of what happens when you allocate an extra $500 a month over a 10-year period during your peak compounding decade. Welcome to the real numbers. Before we break down the three scenarios, let me just say this. If you are someone who prefers hard data over financial hype, hitting the subscribe button right now is going to be the best return on investment for your time today. I spend my days building financial models so you do not have to. My goal is to give you the exact mathematical frameworks you need to optimize your wealth without the unnecessary jargon. So if that sounds like your kind of channel, subscribe and let us get to work. We are tracking a marginal $500 a month applied strictly from age 35 to 45. That is $6,000 a year for 10 years, meaning a total principal of $60,000. We will assume an expected nominal market return of 9% and a marginal tax bracket of 30%, combined federal and state. We are going to see what happens to that $60,000 by the time you reach age 65 across three different choices. Let us start with the ultimate American financial myth. The first major trap is the extra mortgage payment. The standard advice you hear everywhere is to pay off your house as fast as possible. You have probably been told that a paid-off home is the ultimate financial peace of mind, and that all debt is inherently bad. This belief is anchored in historical trauma, primarily the 2008 Great Financial Crisis, which embedded a deep, visceral fear of housing debt into our collective psychology. People began to equate a mortgage with instability and risk. Society assigns a moral virtue to being debt-free, treating it as a badge of honor. But math has no morals. Your bank does not care about your feelings, and inflation certainly does not care about your peace of mind. When we view fixed-rate mortgage debt as an active threat rather than a mathematical hedge against inflation, we make decisions that systematically destroy our future net worth. Let us look at what actually happens when you aggressively pay down a low-interest mortgage. Let us assume you locked in a 3.5% mortgage rate between 2020 and 2021. You decide to take that extra $500 a month and apply it directly to your principal. Over the course of 10 years, from age 35 to 45, you pay an extra $60,000 into that loan. On paper, this feels incredible. You will save approximately $30,400 in interest over the life of the loan. Your home equity increases by $60,000. But here is the brutal trap. Housing equity yields exactly 0%. Your house is going to appreciate at the exact same rate whether you own 10% of it or 100% of it. So what is the future value of this decision when you hit age 65? It is exactly $90,400. That is your $60,000 in principal plus the $30,400 in interest saved. That is the total net worth benefit you generated. Compare this to investing that same $500 a month into a standard brokerage account tracking the broader market at a 9% return. By age 45, that $60,000 principal grows to $96,600. You stop contributing. For the next 20 years, it just compounds in the background. By age 65, that account is worth $541,000. Choosing the mortgage paydown just cost you nearly $500,000 in opportunity cost. Why do intelligent professionals willingly sacrifice over $400,000 of net worth for a paid-off mortgage? Behavioral economics calls this mental accounting. We treat money differently based on subjective emotional criteria. We overvalue the emotional comfort of being debt-free. But making extra payments on a low-interest fixed-rate mortgage is essentially like buying heavy gold bars and burying them in the walls of your house. The house does not grow in value faster just because there is gold hidden in the drywall. Worse, you are ignoring the invisible penalty of liquidity risk. When you put $500 into a mortgage, that capital is trapped. If you lose your job at age 42, the bank does not care that you paid extra for the last 7 years. If you miss a payment, they will foreclose. But if you route that $500 into a liquid investment account, you build a fortress of liquidity. You can actually pay your mortgage from that investment account if you ever lose your income. Liquidity is the ultimate safety, not a paid-off home. To fix this, you need to implement what I call the arbitrage threshold. You must never pay extra principal on fixed-rate debt that is below the risk-free rate of return or historical market yields. Calculate your spread. If your mortgage is locked in under 5%, pay the exact minimum until the day you die. Let inflation pay off the debt for you. Paying off a 3.5% mortgage with dollars inflating at 3% means your real return on that cash is effectively zero. Now, if your mortgage originated recently and sits around 7%, the math shifts entirely. A guaranteed 7% tax-free return on debt paydown becomes highly competitive with market returns. So in that specific scenario, you might split your extra cash right down the middle between the debt and equities. You have to remove the emotion and just follow the spread. But if you think throwing cash at a low-interest bank loan is a massive unforced error, wait until you see how we completely self-sabotage our own retirements in the name of being good parents. This brings us to the second major decision of your late 30s, the generational trap. There is a deeply ingrained societal belief that good parents fully fund their children's 529 college plans as early as possible so they can graduate debt-free. The Boomer and Gen X experience dictated that a college degree essentially guaranteed middle-class wealth. Today, parents are projecting the massive student loan crisis of the 2010s onto their toddlers, prioritizing their kids' education funds over their own retirement accounts. We assign massive moral virtue to sacrificing for our kids. But again, the math does not care about your parental guilt. When you prioritize a 529 plan during your peak compounding years, you are making a fundamental error in timeline management. College costs are certainly terrifying, but letting that fear dictate your marginal cash flow allocation in your late 30s is mathematically disastrous. You are trading decades of exponential compounding for a highly restricted, single-use financial tool. Let us look at the actual numbers. Let us run the numbers on the 529 plan strategy. You invest your $500 a month into a 529 plan, earning a 9% return. Over 10 years, your $60,000 in contributions grows to about $96,000 by the time you reach age 45. That sounds like a solid win. But here is the critical flaw in the math. This money is legally locked into educational expenses, and more importantly, it ceases compounding at year 10. When your child turns 18 and heads to a university, that money is entirely withdrawn and given to the school. What is the future value of that decision for your personal net worth at age 65? It is exactly $0. You transferred the capital right at the exact moment it was about to start generating massive geometric returns. You absorbed a massive opportunity cost during your absolute prime compounding years to pay a university. And while your child might graduate without debt, you have effectively crippled your own ability to generate wealth for your later years. The psychological drive to provide for your offspring is evolutionary, which triggers present bias and emotional reasoning. Parents view fully funding a college education as a binary metric of successful parenting. But this completely ignores basic game theory. Let me give you a logical analogy. Think of the oxygen mask rule on a commercial airplane. In an emergency, the flight attendant explicitly tells you to secure your own oxygen mask before helping your child. Why? Because if you pass out from a lack of oxygen, you cannot help them, and then you both go down. The same is true for your money. A child can borrow money for college. There are federal loans, scholarships, and grants. You cannot borrow money for your retirement. No bank is going to issue you a loan to buy groceries when you are 75 years old. If you underfund your retirement to overfund a 529 plan, you will inevitably become a financial burden on your child later in life. That is the exact opposite of what you intended. The solution here is what I call the oxygen mask protocol. You must secure your own retirement before you direct a single dollar toward a child's education. To execute this, you need to calculate your coast fire number. That is, the amount of money you need invested today to reach your target retirement goal at age 65, assuming you never contributed another dime. Until you have mathematically achieved your coast fire number, your 529 plan contributions should be capped at 0. Your retirement accounts take absolute priority. Once your coast fire number is achieved, then and only then do you start funding the 529. And even then, you only fund it up to the projected cost of an in-state public university. True generational wealth is not just about paying for tuition. It is about ensuring your kids never have to pay for your long-term care or medical bills when you are 80. That is the real gift. We are about to get into the absolute apex strategy for your money. I'm going to show you a tax loophole so powerful it is practically a government match on your wealth. But before we get to that, we need to talk about execution. Understanding the math is only half the battle. Actually tracking these spreads, calculating your coast fire numbers, and managing your marginal cash flow requires a reliable system. That is why I built the ultimate personal finance dashboard, the debt payoff tracker, and the monthly budget planner. These are the exact digital spreadsheets and mathematical systems I use to optimize my own money. They remove the guesswork and give you a crystal clear, real-time picture of whether your cash is being deployed optimally or whether it is trapped in a low-yield mortgage. You can find the links to all the official Tom Talks Money templates down in the description. Grab the ones that fit your current phase, set up your system this weekend, and stop leaving hundreds of thousands of dollars on the table. Now, let us talk about the single most mathematically powerful account in the American tax code. The third and final decision of your late 30s revolves around healthcare, specifically the Health Savings Account, or HSA. The conventional wisdom surrounding an HSA is fundamentally broken. Most financial advisors and HR departments will tell you to use an HSA to pay for your current medical bills tax-free. Or worse, they tell you to avoid it entirely if you expect to have immediate medical expenses. This stems from profound financial illiteracy regarding tax code optimization. The average American treats an HSA like a checking account for copays and prescription drugs. They put a few $100s in, and the moment they get a medical bill, they pull the money right back out. When you use an HSA as a short-term checking account, you are completely nullifying its power. You are taking the most highly optimized, mathematically dominant investment vehicle in existence and treating it like a glorified coupon for a doctor visit. We need to completely reframe how we look at this account. Let us run the math on the HSA Apex Strategy, which is the clear, undisputed winner for your $500 a month. The HSA is triple tax advantaged. It goes in pre-tax, grows tax-free, and comes out tax-free for medical expenses. To get $500 of post-tax money into a standard brokerage account, you actually have to earn about $714 pre-tax. But by routing that $500 straight through payroll into an HSA, you instantly capture a 30% tax arbitrage. You are saving roughly $214 a month in taxes immediately. Now, here is the secret. You never actually spend the HSA money on current medical bills. You pay those out of pocket, and you invest the HSA funds directly into the market. Invested at a 9% return, your $60,000 in principal grows to $96,600 by age 45. Let it compound for another 20 years, and it reaches $541,000. But unlike the standard brokerage account, this $500,000 is entirely tax-free upon withdrawal for medical expenses. Let us anchor this concept because people severely underestimate the psychological advantage here. Think about the government match. Most people eagerly max out their 401k to get a 5% employer match because turning down free money feels foolish. Yet, an HSA completely bypasses federal income tax, state income tax, and FICA payroll taxes. That acts as an immediate 30% government match on your money. Ignoring an HSA is voluntarily paying a 30% penalty on your wealth generation. Furthermore, you have to consider the brutal reality of late-stage healthcare costs. Fidelity estimates that an average retired couple currently needs roughly $315,000 completely out of pocket for healthcare expenses during retirement. That is a catastrophic drag on your late-stage net worth. The HSA is mathematically the only tax-optimized tool designed specifically to absorb this massive financial blow. It acts as a dedicated fortress to protect your traditional retirement accounts from being drained by medical facilities when you are in your 70s and 80s. To execute this, you must implement the HSA Maximizer protocol. The rule is simple. If you have access to a high-deductible health plan, you max out the HSA before you even think about funding a 529 plan, making extra mortgage payments, or putting money into a taxable brokerage account. Treat the HSA strictly as a retirement vehicle. When you get a current medical bill, pay it out of pocket using your standard cash flow. Save the digital receipts in a dedicated folder on your computer. Because here is the ultimate loophole in the tax code. There is currently no time limit on reimbursing yourself from an HSA. You can save a receipt for a medical bill you paid in 2026, let the money compound in the market for 2 decades, and then withdraw that exact amount tax-free in 2046. At age 65, the rules open up even more, and it acts exactly like a traditional IRA for any non-medical expenses. When we step back and look at these 3 decisions, it all comes down to the rule of 72 and the reality of geometric compounding. If you divide 72 by your expected interest rate, it tells you exactly how many years it takes an investment to double. At a 9% market return, your money doubles roughly every 8 years. This means between age 35 and age 67, your money is going to double exactly 4 times. Your initial $60,000 becomes $120,000, then $240,000, then $480,000, and finally approaches $1 million. Every single $500 increment you misallocate today is geometrically punished later in life. Putting it into a low-interest mortgage yields roughly $90,000 in net worth benefits. Putting it into a 529 yields 0 for your personal net worth. But putting it into an invested HSA yields well over $500,000 of completely tax-sheltered wealth. You just have to follow the math and ignore the noise. If you have made it this far into the breakdown, you are exactly the type of analytical thinker we want in our inner circle. We are building a community of people who refuse to let emotion dictate their balance sheets. I want to invite you to click the Join button below this video and officially become one of the optimizers. Channel members get exclusive priority replies to their comments, meaning if you have a specific question about your personal spreads or account allocations, I will see it and respond. You also get custom sketch badges next to your name, so everyone knows you actually run the numbers instead of blindly following conventional advice. It is a great way to support the deep dive research we do here while getting direct access to the community. Click Join and I will see you in the comments. Ultimately, the decisions you make in your late 30s create the baseline for the rest of your financial life. You can choose the emotional comfort of a paid-off house and a funded college account, or you can choose the mathematical certainty of maximum net worth. The math has no feelings, and that is its greatest strength. It gives us a map that is completely immune to panic. I want to hear from you. We treat the comment section here as an open peer review process. Drop your current mortgage interest rate and tell me how you are currently allocating your extra monthly cash flow. Let us gather some real-world data and see how the community is balancing the spread between debt and equity. Keep optimizing, rely on the math, and I will see you in the next breakdown.